Hello, welcome to this week's installment of Your Money Matters. We're continuing our theme, confessions of a typical financial planner, and kind of our sub-theme inside of that, where we've talked about what you should be doing some different things with your money. We're going through some specific examples of what to do. And this week we're going to focus on real estate, which I'm sure is a big surprise of you that knows me, from all those that you know me since I spent 20 years in the mortgage industry. Big proponent of handling real estate the right way, the smart way. Typical financial advice, from the media, the banks, Susie Orman, Dave Ramsey, they tell us when you're thinking about buying a house, that you need to save 20% for a down payment. You're going to purchase a home with a 15-year mortgage if you can afford to do so, or get that 30-year mortgage and pay extra principal against it so that you can pay off your home early and then save for retirement. So in 15 to 25 years, you have a free and clear home. Unless you refinance it, as many people do, or you don't live in it very long, because turnover rate's around 9 years, I think, something like that on average. So when you start looking at the reality of life, the things that the traditional people are telling you to do really start to fall apart. But I get it, because on the surface, this really makes sense. But when you consider the alternative economic strategies that we've been talking about, see, alternative economics encourages ownership of assets as the stepping stone from being comfortable to being truly prosperous, truly financial free. See how typical financial advice actually prevents people from expanding their asset base compared to what alternative economic strategies teach and have you do. See, alternative economic strategies, they suggest there's no need to wait to save that 20% down while throwing away years of extra rent payments, just throwing those down the drain. Purchase a home when you can afford to do so, even if you utilize low down payment programs, even if you have to pay private mortgage insurance, even if you have to pay a mortgage insurance premium with FHA. See, they've made those for most folks, depending on your income. Always consult a tax advisor. I'm not a tax advisor. Made those mortgage insurance premiums tax deductible. So think about it. When you, how long is it going to take for me to save? If I'm renting a place, how long is it going to take for me to save 20% down? So in all those years that I was renting, I wasn't gaining anything, right? Now, in some markets, I'm in Kansas City, not here. In some markets, it makes sense to rent rather than buy because the house prices are so expensive and rents are not. So, but in an area like where I'm at, like in Kansas City, where rents are actually probably more than what a payment would be, even with a low down mortgage with private mortgage insurance, and the fact that you're building equity, and as you pay down your mortgage, and then hopefully as the homes appreciate. So don't fall into that trap. That was something that we battled a lot when I was in the mortgage industry. People were thinking that they needed to wait to save for that. Then don't get that 15-year mortgage. Get the 30-year mortgage with lower down payments. And rather than paying extra against your mortgage, as you can afford to do so, save more money in other assets. And some of those options might be properly structured permanent cash value life insurance policy. That helps you build liquidity. It also gives you a lot of other protections too, and it protects your money. Or when you have sufficient funds, maybe investments, maybe into commercial mortgages, rental real estate, life settlements when you really get quite a bit of money. See, in that case, in 30 years, you'll have a free and clear home plus additional homes or additional other cash flowing investments or assets. In the meantime, you're going to have greater financial security and control of your money by building liquidity or other additional assets. See, when you pay down your principal, it puts money out of your reach, out of your control, while adding nothing to the value of your home. Think about when the market crashed 2007 to 2009. Who did the government help? Did they help homeowners with lots of equity? Or did they help homeowners who were buried because they had a mortgage and their values dropped? Okay, now that's not an ideal situation, but that should tell you something. Who did they help? They helped those people that were in trouble, not the people that had done things the right way, so to speak, that were always taught. So keep that in mind when we're talking about alternative economic strategy, alternative retirement strategy. We're talking about things that are going to be beneficial to you and not the financial institutions, the government, and everybody else that's teaching you all the things that they want you to think is right for you. All right, so if we save and invest on the other side rather than striving to pay off a mortgage, you increase both your asset base and your future cash flow. Okay, and when we talk about retirement, because that's the ultimate goal here, retirement is not about building up a bunch of assets. It's about income. Don't let anybody tell you different. But really, the only time that maybe building of assets becomes more important is if you're in that top 1%. And if you're in that top 1%, I'm going to bet you money you're not watching this. Okay, so this is for the other 99% of us out there. So what's the result of utilizing these strategies? Well, here's an example, okay? A client purchased her first property, let's call it property A, for $110,000 using a 3.5% down payment FHA loan. A few years later, she saved money for a down payment on her second home, property B, and then she turned property A into a rental property. Okay? A little over 2 years later, property A had gained further appreciation, and she was able to sell it at a profit of about $90,000. So with the tax-free proceeds, okay, and we'll go over this a little bit more, because she followed some rules which are unique to real estate, she was able to get that money out tax-free. So with that, she purchased another rental property, had the down payment for that. We'll call that property C. She then paid off all of her consumer debt. She bought a car. She took a vacation to Hawaii. 2 years later, she refinanced her second home, property B, and she used the proceeds as a down payment on a new home, property D, turning property B into a second rental property. Less than 3 years later, she sold the two rental homes, property B and property C, for a gain of a little over $200,000. Over half of that money was not subjected to taxes of any kind because she had lived in the home for 2 of the last 5 years. Okay, so she owned it as a primary residence 2 out of the previous 5 years. She still owned property D, okay, that she could either live in or rent for positive cash flow if she desired. So here's the deal. In 13 years, she had created windfalls totaling about $300,000. So, and we didn't even mention property E, another rental that she purchased with a partner while she still owned property D. And it lost some equity in the downturn. Unfortunately, that happened for everybody. It still continued to cash flow, and eventually its value rebounded and even rose. She sold that for a $33,000 profit. And at the time, she was a single mother, okay, earning about $60,000 a year in her day job. Right? Could she have saved $300,000 in her salary in the same amount of time following typical financial advice? Absolutely not. But by utilizing many of the alternative economic principles or strategies with the assistance of a healthy real estate market, we needed some help there, she was able to think prosperously, think alternatively. She was able to see the big picture. She was able to control her money and her investments. She moved her money through assets, not just to assets, and multiplied the dollars and the jobs that they did. That's big. We don't have that much money usually, folks, so we need to multiply the jobs that our money does, and traditional financial planning does not do that. If she would have just stayed in her first home, accelerated her mortgage payments, she would still be paying on her home, and she would have not enjoyed those windfalls created through ownership of additional properties. Okay. Now, as you can see, alternative economics is a powerful way of optimizing and even multiplying your dollars. When we stop focusing on rates of return and focus more on the alternative principles, we can increase the velocity or movement of our money. So you can see now how alternative economics changes the conversation and challenges the questions that typical financial planning and big financial corporations are asking, and they're trying to get you to ask, okay? So here's what they're saying. They're saying, all right, what's the right ratio of stocks and bonds? How much do I need to save to retire at 65? What rate of return will I be projecting my investments to earn? How can I maximize my tax deferrals through a qualified plan? Folks, if you take one thing away from here, get away from these qualified plans. All right, I know they're the panacea, the greatest thing since sliced bread. Oh, especially when you get an employer match, folks. I'm telling you, they're not. When you really look into them, they're not. They're a Trojan horse for your retirement. How can I maximize my, what's the quickest way to pay off a mortgage, right? See, alternative economics, they turn conventional wisdom on its head. Alternative economics doesn't focus on how much money you have, but on how much freedom you have with your money. Can you use it if you wish? Can you borrow against it? Is it tax advantaged, not tax deferred? Okay. Can you pass it on to a spouse or your children easily and with minimal costs? See, rather than encouraging you to hand control of your dollars to an advisor, an institution, or the government, alternative economics wants you to have control, liquidity, use, and equity. Okay. So now that you're beginning to get familiar with the principles and strategies of alternative economics, what are you going to do with this information? That's kind of what we'll call a tease for, we'll start next week, and we're going to start down that path next week. So I hope you watch this. If you have any friends, family, anybody you think might be interested in this information, please share this with them. I encourage you, if this is the first one you've watched, I encourage you to go back and watch some of the previous ones, especially in this series. This series from the Confessions of a Traditional Financial Planner. There's a lot of great information in it. Or if you just want to save some time, give me a shout. My contact information is up there on the screen. Be happy to have a conversation with you. Look, we're not high pressure or anything. We talk about, teach people these things. If they like them, then we do business with them, because they typically want us to help them, because hardly anyone else out there is doing these things. So, and if you want to keep going in your traditional route, that's great. That's fine. We hope it works out for you. We're not going to bet that it will, but we hope that it does work out for you. So keep these things in mind, folks. I know it's a totally different way. You got to change the way you think. And I started changing the way I was thinking about this back starting in 2003. So it's been a nice long process that every time I pick up new information, it just reaffirms it. As we speak now, the market's been dropping. But I'll tell you this, I think the market's down 7.5% off its high from May. All my clients, none of them have, all the ones that are implementing the plans that we've put together for them, haven't lost a penny, folks. That's how we utilize the tools that we have from our alternative economics, so alternative retirement strategies. So thanks for tuning in. I hope you tune in next week. If you have questions, concerns, or anything you want to have a conversation, just give me a shout. My information's up there on the screen, or shoot me an email. Have a great week. See you next week.